Today, we are going to talk about peer-to-peer lending, and I am going to go over the points that are really important before considering this as an investing option. So I'm going to cover what is peer-to-peer lending, what does it look like to invest in peer-to-peer lending, what are the risks, and just my overall opinion. So let's jump right in. Hey everyone, this is Lauren Mack with Hacking the Rat Race, and I would love for you to hit the like button and subscribe so you don't miss any more videos on money, saving, and investing. So first, what is peer-to-peer lending? Essentially, peer-to-peer lending is like bank lending, except you're cutting out the bank, and it's just ordinary people pooling their money through a lending company and then lending to other people. So historically speaking, if someone wanted to get a loan, then they would probably have to approach a family member or go to a bank and ask for that loan. However, with peer-to-peer lending, it has created a third option, which is going to a lending company and borrowing from other people. There is also a misconception about peer-to-peer lending, and that is that peer-to-peer lenders generally lend to subprime borrowers, which means borrowers that couldn't get credit at a bank because maybe they have bad credit, a high debt-to-income ratio. However, there has to be something considered because when I've researched this, oftentimes the interest rates, origination fees are much lower at banks. So you have to wonder, why would someone choose this option over a bank? There are some instances I found where people could get better rates at peer-to-peer lending, but generally speaking, from what I saw, the rates were better with banks. Obviously, rates are changing all the time and what's going on in the market, so clearly this could change. But it was one thing that I thought was a little bit interesting. You would think for people to move from, say, the traditional banking system over to peer-to-peer lending, there would have to be a good incentive. So we're gonna get to that in a little bit later, but first I wanna talk about what it looks like to invest in peer-to-peer lending. So for investing in peer-to-peer lending, in most companies, especially the big companies, you sign up for an account, you determine how much money you want to invest. You could invest that in all of one loan or multiple loans. It is recommended to put it across multiple loans so you're diversifying your investment and there's less likely of a chance of one loan defaulting and losing all your money versus little pieces here and there. And then what happens is over the period of that loan, the borrower just pays you back over time. And generally these loans are about 3 to 5 years long. So once you invest in that loan, your money is in that loan and the borrower's paying you back principal and interest over time until the loan is paid off. So now let's look at some of the risks. So the first risk is just losing all of your money, right? If you go put all of your money in one loan, for example, and that borrower defaults, then you might lose all of that money. So what they recommend is putting it over, like I said, if you have $1,500, 60 loans, that's $25 a pop. Let's just say 5 of those default, then you have 55 other loans to make up the difference. Therefore, it isn't a massive impact. And I would like to add here too, that depending on the credibility of the borrower, just like bank borrowing, they can have higher interest rates, lower interest rates, different terms. So on the back end, as an investor, you can see this. You can see their creditworthiness. You can see, depending on the company, what the odds are that they are going to repay. Each company kind of has their own system on how this looks. So if a borrower is more risky, the interest rate's higher, which means you could make more money if they pay. But if they don't pay, then you obviously have the higher risk of losing all of your money. So you can look at all of these loans and you can kind of determine your risk profile if you want to get a higher interest rate, but also a higher risk of default. So that is number one, is just the fact that it's possible you could lose all of your money. If you invested, let's just say, in those 60 loans and all of them defaulted, then yes, you could lose all of your money. The likelihood of that happening is probably pretty slim, but ultimately that is one of the main risks, is that you can just lose your money if the borrower does not pay it back. So the next thing to consider, and it sort of piggybacks off of what we were just talking about, is these companies have only been around. In fact, Prosper was the first one in 2005. And besides the 2007, 2008 downturn, which Prosper and some of these other companies were either just getting started or they were in their infancy stages, it's still yet to be determined when going through a full downturn or crisis or recession, what the default rates will look like. And since these are unsecured loans, generally speaking, those are some of the first loans that go unpaid. So the risk there is yet to be fully determined. Maybe in the next couple years when we get through the current crisis, we can look back and evaluate that better. However, being in this volatile time, that could be a concern. And if the economy gets worse, again, the first thing people stop paying if they can't afford to make all their payments is going to be their unsecured debt. So that is something that we will need to evaluate in the future, but you should definitely consider. The next issue or risk is that your money really isn't liquid, right? Let's just say you took that $15 and you invested it in all of these loans, and let's just say they had a 5-year term. Well, then you have to keep that money invested for 5 years. So let's say something happens in 3 years and you need and or want that money, then you are not able to access it. However, Lending Club does have a small secondary market where you can sell some of these, but again, it is very limited and you'll be taking a pretty substantial loss if you go that route. So let's just pretend like that isn't an option, because for most of the lending companies, it isn't an option. And even with Lending Club, with the amount of money that you will be losing, it probably wouldn't be worth it. So your money is tied up for that period of time. And again, unlike say stocks, where if the market starts going down and you get a little nervous, or maybe it is the right time after speaking to your financial planner and you need to sell, you can get out. But with this, you're basically loaning money for a set term. So one thing to consider is just over that term, your money is not liquid. The next thing to consider is this. Say, for example, a bond, which is similar in a way. In a bond, you are loaning your money through purchasing that bond to either a company or some kind of government entity. And over time, they pay you interest on that bond. And at the maturity of that bond, they give you your principal back, right? So at that time, you could decide what you want to do, reinvest that money, whatever that looks like. However, with peer-to-peer lending, you're lending that same amount of money, but each month you're getting your principal and interest back. So if you don't reinvest that money, if you say spend that money like you would say on the interest of a bond, then at the end of that loan term, you're not gonna have any money. So it's not like the principal's being held, you're loaning that money, just like if you loaned Aunt Sally money and then she paid you back over time, say with interest. So it's something to consider, because sometimes people don't think about that. They treat it more like a bond, and then at the end of the term, that investment is pretty much gone. So yes, you made the interest during that time, but you also got your principal back. So if you're looking at this from an investing standpoint, then obviously when you got that principal money back, meaning the initial money that you lent, then you would need to keep reinvesting that money. Now, you have that option with these companies to reinvest that money. In fact, you can reinvest all the money that you get so that it grows and grows and grows. But just remember, every time that you reinvest that money, it's for another 3 or 5 year term. So that's just longer down the road that your money is not liquid. It's just something to consider when looking at different investment options. And for this one of the kind of downsides is it doesn't have very good liquidity. Something else to consider with peer-to-peer lending, and one of the issues that I have is this. Okay, let's say you have a loan, like I said, to Aunt Sally, right? And so you're making that loan determining if Aunt Sally can repay you, right? You know, if she's good for the money, what her investment's like, and basically your only risk is Aunt Sally or whomever not paying you back. With Lending Club, you're lending to, say, an Aunt Sally. You're lending to just another ordinary person. However, you're basically loaning your money to the lending company, and then they're lending that money to that person. So yes, you are investing in that loan, but technically you're really investing with the lending company, and that lending company is in turn investing with that person. So the other thing to consider here is you kind of have two risks now. So the first risk is the borrower going to pay you back? Is that person going to be able to pay you back? But the other risk is the viability of the lending company, right? Because here's the deal. If you go and say put that $1,500 into the lending company and maybe they mismanage their money, I don't know, there could be an array of things that happen, but if that company goes under, then there's a good chance you're also going to lose your money. Now, if they're well invested, well run, etc., you definitely need to do your research. I would say just like you would if you're investing in any company, probably talk to a financial planner. But the point is, now you have two areas of risk, in my opinion. Number one is going to be the borrower paying you back. And number two is going to be the viability of the company that you are investing in. And again, you're investing these over 3 to 5 year terms. So just like anything, if you invested in a company, say in the stock market, and it wasn't liquid and you had to give them that money and not pull it out and not the option to pull it out for 5 years, then to me, that is even more risky. Obviously, this isn't the same as investing in a stock. It's actually very different. But the point is, you definitely need to be careful about the lending company that you're basically lending with. I would definitely do research and I would definitely keep up with them. And this is a small risk, right? A lot of these companies, again, Prosper's been around since 2005. So it's not like you're investing in year 1 or year 2. You can kind of look and see how things have gone over time and probably have some idea of what it's going to look like in the future. But just remember, there is that next level of risk as opposed to just true peer-to-peer lending, like lending someone money directly. And the last thing I think it's really important to consider when doing peer-to-peer lending is really looking at the terms. There have been numerous articles and claims that these companies don't fully vet out their borrowers. And if you remember earlier in this video, I was talking about why would someone go to use peer-to-peer lending if they could get a bank loan. And from what I've seen, it seems like bank loans have better terms and better rates. So then why would someone go to peer-to-peer lending? And one reason is probably because they may not be subprime. They may not have horrible credit and a massively high debt-to-income ratio, but they also might not be superb and they couldn't get a loan with a bank. Therefore, they chose this as an alternative method. So if that's true, then basically what's happening is people that can't get loans, but maybe aren't in a horrible financial position, are able to get loans with these companies. And again, there have been all kinds of articles, stories, maybe even rumors that all of the borrowers are not fully vetted. And here's the thing, if you're taking your money and you're investing your money in that company, then you're having some faith on their vetting process. And if you think or feel or know that their vetting process is not sound, then again, that cranks up your risk. Because if they're telling you, this borrower is really a medium risk, turns out their debt to income ratio is sky high, or maybe their income isn't exactly accurate, well then that changes the risk of that loan and that investment, and maybe you wouldn't know that. So again, it's just really important to look at the company that you're going to invest in, do a lot of research if this is something you're going to do, and check out the terms and what they say, how they vet their borrowers. Are they vetting all of their borrowers? How do they classify the risk? And just really consider that. Because again, I feel like most people, if they qualified for a bank loan and they were going to get better terms, because there are tons of bank loans that don't have any origination fees. With these lending clubs, the way that they make money is A, they charge an origination fee, and sometimes it is fairly high. They charge the investor each month. With companies like Lending Club, you have to pay 1% each month. So they're collecting fees, and oftentimes because banks are super competitive amongst one another, there could be no origination fees, and depending on the size of the loan, that could be a substantial savings. So I'm not saying that some people don't just consider this because it's probably easier and faster, but I feel like most people would at least try the bank first. And obviously you need to have faith in the vetting process of whatever lending company that you invest in. So I told you at the beginning of this video, I would give you my overall opinion. I'll be honest, when I first looked into this, I was really excited. And this is before I started digging deep. When I just looked at the average returns on investments, especially the anecdotal returns on investments, and just kind of how the process worked, cutting out the middleman, the bank, I thought, wow, this is really awesome. However, when I started looking into more of the details and kind of digging into it, some of the returns that are stated, I think, are overstated. There have been people who have shown their returns and they're not bad, especially compared to the amount that you would get on a high interest savings account at the moment. That being said though, the fact that if I can't fully trust the vetting process, and if a borrower defaults, I completely lose that piece of the investment, then having to, worry about, is the borrower going to repay, and the viability of that company on a long-term basis, not truly being tested through a crisis, all of those things made me decide to pass on this investment strategy. But I think if you're considering it, I would just make sure that you fully research the lending company that you're going to use, and try to find people who are using that lending company and kind of find out what their true returns are and what their experience is like. But no matter what, I highly recommend making sure you do your research and not just jumping in and investing in one of these without doing the research, because I feel like there could potentially be a high risk of loss. And if a borrower defaults, the chances of you getting any of your money back after that default period is super low. And if a lending company were to default, well, I still think your chance of getting any of your money back is pretty slim. And if you did, it would be probably pennies on the dollar. So I want to hear from you in the comments below. Are you doing peer-to-peer lending? Do you like it? Are you thinking about doing it? I want to hear your experience in the comments below. Thank you so much for watching this video. Don't forget to hit the like button. It literally costs nothing and it does so much for this channel. And don't forget to subscribe so you don't miss any more videos on money, saving, and investing. Thanks again, and I'll see you in the next video.